I love when StreamYard tells me I'm late. It's always like, you're late. I know I'm always late. So hey guys, we're with Steve at the Money Strazza and myself, Jason Pers, and we're kind of just talking about some random stuff today. So what we usually this shows with me and Kashab, and we kind of go through a bunch of what's going on in the markets, what's going on in the macroscape. And Steve and I can go through the same things, and Kevin's going to be on with us soon. But, Steve's always fun to come on and kind of talk about trading stuff, but how we're actually trading, what's actually going on with the market. So I want to kind of make this conversation a little bit more into that sense, covering the technicals, covering levels. Let's see what's going on with the market. What's going on with the market, Steve?
Well, we had a busy week, right? The market is, I think, still digesting the news and events of this week. We had a CPI, we had a Fed, we had a PPI. Sometimes it takes more than just an afternoon to kind of figure out the short-term direction or trend coming off of these events. I think the market is still kind of doing that now. So what's exactly been going on at the index level? We've been buoyed by the $3 trillion club, some mega cap tech earnings beats like Adobe today, Broadcom yesterday. Beneath the surface, I mean, it's the same situation today. Yesterday, we had something like 420 declining issues on the S&P, around 400 again today, right now. So it's not good. That's kind of been the tail of the tape for a couple weeks at this point. Just really, really narrow breath, mega caps kind of holding up the indexes, and then things falling apart beneath the surface in a way. If you look at something like small caps, don't love the price action there. So IWM, it's all about 200. Russell 2000, it would be the equivalent level would be 2000. We're cutting to, I guess, a fresh monthly low, lowest level since May today. You don't want to see that. The Dow has been weak. Stuff like ARK, speculative tech, has been weak with bright spots. Inside of it, you can always find a leader or a stock going up in these groups. But as a group, speculative tech has really struggled. Stuff like China, risk on markets overseas, not doing so great out here. So again, mixed market, narrow market. We need to see more from a breadth perspective, but you don't have to buy the bad ones, right? That's the nice thing about the stock market. We don't have to swing at everything. We don't have to buy the ones that aren't doing well. We can buy the leaders, and there still are some really good market leaders that are trending incredibly well. So
no, for sure. And that's the thing that I think is really interesting to me is that tech keeps leading. Tech keeps leading the way. That's something to me that I keep watching and keep going like, man, it's kind of interesting because even for myself, I started to really think about the reflation trade happening. And we kind of saw it start this year, and we started seeing energy and financials as the outperformers. As awesome as that was, we're still seeing tech leading the way completely. Tech is in first place. We saw utilities have a nice run for a little while. Then that gave it back pretty quickly. That's something that's always kind of fun about the utilities trade. it tends to do that quite a bit. So you see these crazy runs in utilities and it gives it back. But if we're looking at, year to date at this point, technology is up 18%, and it's leading the way. Communications right behind that, which is basically tech. Google's their main component, up almost 16% today. The S&P 500 is up 13% for the year, mainly comprising of those tech gains is why we're been up there. And then all the way at the bottom, we have a lot of these defensives, which are real estate sector, mainly REITs are in there. We have materials also near the bottom. Bonds, obviously everybody knows that, even though they're getting a bit of a run, they're still near the bottom. And so that's kind of an interesting way to look at it here. In a 3-month time frame, yes, utilities are still up there, but they're finally giving some back. I wouldn't expect them to lead the way until we see bonds start to really lead the way. But once again, it's something that we could talk about too, is that bond trade and the utilities trade. And what are you thinking about bonds?
Yeah, I like bonds. I really do. I think rates are coming off now. I don't love the divergence, just very, very near-term divergence between dollars and yields, right? Dollars making what, 1-month highs today, and rates are hitting their lowest level since March, the 10-year. So that's a little bit strange. That's something new and different, right? Those two not moving in lockstep together. So I think you keep an eye on that. I think rates are actually more important than dollars. And I think you were just reading off the trailing 3 months, right?
Yeah.
Look how bifurcated things are. So I have the equal weights here. And like you said, tech and utilities each up over 6% over the trailing 65 days. Everything else is red on an equal weight basis. Not great. So then you say, okay, what about the last month? Tech is up about 4%. Everything else is down 1% or more. Materials and energy down almost 6% on an equal weight basis over the trailing month. So it's almost like we're back to this super, super thin market that we were in last year. Remember, it's only the Mag 7. You remember that?
Yep.
Only
So,
the 7 again. Here.
Yep.
Again, can you find pockets of strength? Am I saying only the Mag 7 is working when I said it? No, but they're doing all the heavy lifting. They're doing all the work out here. It's funny, Jason. It's almost as if relative trends persist. It's almost as if the early cycle leaders are still the big leaders today. Look at something like semiconductors, right? Semiconductors are having a party out here. Nothing else is working. Semiconductors absolutely rocking out. It's been by far the best industry group this entire cycle, and it's still the best industry group today. So relative trends, like absolute price trends, persist.
no, I agree, and that's a good way of putting it. Which is, once again, when we're looking at last year, and this is something you and I talked about a ton, which is, when you're in the last year and you're getting this major trend, and everybody's going, well, it can't keep going because it's only these leaders. It's just not how it works. Most of the time, strength begets strength. This is why, as technicians like Steve and I are, we look at relative strength. We look at relative performance. And then we understand that if we buy those leaders, most of the time those continue.
Yeah.
It's not, and it's the opposite of what most people think of trading. For example, if you had 2020 and you have this major crash and you look for what was the worst sector in there, that has still underperformed what has been the leading sector, which the main leading sector out of 2020, I'm pretty sure it's tech without looking at it, but let me double check that just to make sure I'm not just saying words here, but I'm pretty sure it's tech. So semiconductors, obviously, if you look at a subsector of tech, but just talking about the main sectors here, let's go back 2020.
It's energy, isn't it? Off the 2020 lows?
Off the 2020 lows, energy, well, if we do the exact lows, that's different. But if you go from the beginning of 2020, tech is leading the way. If you go in the last 5 years, tech is up 211%. Energy right behind that up 84%. Now, once again, it was the thing that crashed the most. Not saying it crashed the most in the middle of that cycle. What actually crashed the most in the middle of that cycle was financials. So KRE, XLF, these things fell a ton. Energy was already crashing, so it's hard to really say how far energy really came down. But energy, we like energy. We still think it was a good place to be for a long time. It still is to me. It's still in a relative uptrend, primary uptrend. But technology, you really can't get out of it. We talk about a lot on here and this is what I always say. I start to put on these trades, for example. I look at the reflation trade and I go, okay, for the fun now, we're getting signals in the reflation trade. We're starting to see that we could move into with breadth widening in this market. We started to see that at the beginning of this year. We start to see energy. We start to see financials. You heard you talking about the banks a ton. We start to see these things start to move in a big way. They're starting to show major relative outperformance. Great. However, does that mean that I take those trades and I take the technology out of my portfolio? No. I do not do that. So I always keep the tech trade on until it gives me a signal to sell. It has not given a sell signal in years in the long-term portfolio. In the short-term portfolio, the last sell signal was in October 2023, and now and then it became a buy signal back in November, and then it's been a buy signal since November. So, I mean, it's been a major uptrend.
Listen, for our time frame, right? Like over a primary trend perspective. So you could do this at home. Take a chart of XLK SPY, right? So just look at large cap tech relative to the broader market. You can go back 20 years, Jason. Mm-hmm. It's steadily higher with few drawdowns. And none of these drawdowns are really even a big deal. I'm talking about the relative trend. So we've had 20 years of steady performance, secular leadership from tech stocks I'm not saying that lasts for the rest of our lives, but for as long as that trend is in place, you don't want to bet against it. Don't bet against big tech. These are the biggest, baddest, most powerful companies in the world with the largest pocketbooks, right? They're going to invest in all the new growth trends. One of the things we've been doing this year that's been so good, and we're seeing it again just today with Adobe, whenever there's a narrative around one of these mega cap techs, it was Google earlier this year. It was Apple, like a month ago. Everybody loves Apple now. Apple's the king of AI today, but a month ago they missed it. They missed AI, right? Any of these mega cap techs that are getting hit because they missed AI, buy them. Buy them blindly at this point. These guys, it's going to be hard to miss because they have so much cash to invest, right? So Adobe, a huge earnings beat, up 15%. This was one of the latest, they missed AI stories, right? They continue to not be true, these stories. So these big cap techs, they're just so good. Of course, can you find some weak ones that we don't want? Sure, but you can literally just pull up the XLK components. You can do it with SMH too, and just go right on down the line. A lot of new record highs, a lot of new all-time highs in an environment, in a tape where there are not too many new highs right now. In fact,
and let's take a look at that. You know, we were talking about this before, and so Stephen was bringing this up, and I was like, okay, let's just look at that 5-year window. And here's technology in a 5-year window. You know, we had a nasty drawdown in 2022. I'm not saying it's always the time to buy tech. There's people who go, you got to own tech. You got to always own tech. It's the only thing to own. No, markets rotate. In 2021, late 2020, or into 2021, into the beginning of 2022, energy was a major outperformer. So we rotated. We had different positions at that point. However, you know, if tech is leading the way, I think so many people go, the valuations, it's long in the tooth, it's this and that, overbought. Those are ridiculous things to say. Like it is an insane thing to say something is overbought all the time, because overbought usually means a new trend. It doesn't mean it can't come down. It doesn't mean we won't see pullbacks. I'm just saying you want to bet on the thing that's moving up strongly. Yes, you're going to have volatility, but that's just how it goes.
You know, you mentioned valuations, Jason. You know what else tends to trend? Multiples.
Multiples. Yes.
Why? Because price trends, and P is the numerator of your multiple. The E changes every 3 months? Every so often. So the multiples, what I'm trying to say is when stocks are in uptrends, not always, but a lot of the times, most of the times, their multiples are in uptrends too, which means that as you're making money on that stock, it's getting more and more expensive. Valuation's going higher and higher. So what everybody wants to do is fade valuation, buy the low one, sell the high one. They actually trend. So you want to buy high valuation tech stocks and sell them when they're higher valuation tech stocks.
No, that makes perfect sense, and it's incredibly, that's the hardest thing to do. And so there's something we can kind of talk about here, which is kind of interesting, which is the hardest thing to do as a trader is to do the opposite of what you do at the grocery store. I say this all the time, but it's like the damn truth, which is like at the grocery store, you're looking for the best thing at the best value. As a trader, like you might be buying, so it's, for example, somebody said the other day, you know, they think of the idiots in the market, and they go, well, the idiots in the market are buying those new highs. That's bullshit, because most of the time, the people who are new to trading will never buy a new high. They could care less. So usually you'll see volume draw up or dry up sometimes during new highs, new all-time highs. You see volume dry up. The only people really selling are people who have to sell at those points, meaning big funds who need the liquidity to get out of positions and so on. So for the most part, you won't see a bunch of selling or a bunch of buying there. And so you'll see selling, you'll see lower volume, you'll see most people getting out of it. It's the opposite of what most people do. So most of the time, and you know this because if you study it at all, if you buy new highs, you actually tend to make more money than trying to buy new lows. If you buy a 52-week low, for most of the time, you're going to continue to buy the next 52-week low and the next 52-week low, because it's just going to continue to go that direction. Trends exist and they persist.
Grant had a good chart on that this morning. Did you see it?
No, I didn't see it this morning. I was at a meeting.
I'm going to have it. We'll throw it up.
Nice. Let me see. I think you should have permit. I try to make it so everybody has permissions, but it changes from time to time. Just let me know if you need them.
Here, I just DM'd it to you. You just do it.
Okay. On my phone?
On your Twitter.
On my Twitter. Perfect. Okay. That works. Let's see.
I told you I overuse the Twitter DMs. It's not even going through. There it goes. Yeah, I'm at peak Twitter DMs right now.
Peak Twitter DMs. Nobody sent Steven any more DMs. He's having some trouble here.
I'm catching up. There's a backlog. Yeah.
It's gonna take some time. Be patient.
But this chart, we've shaded it in gray for periods or days, really, but it ends up being periods of time. Days where the market closed at a new all-time high, not even a 52-week high. And what you see is that you tend to want to be invested when the market is making new all-time highs or setting new streaks of all-time highs. I think we're like 4 days now for the S&P. We've seen 8 days a couple times in the past, actually even recently. I think the record is you got to go all the way back to like the 60s. Yeah, it's the 11 days. So like a new all-time high streak, isn't by itself a reason to go run and sell things, right? Duck for cover. But if breadth is consistently this bad, it's only a matter of time before the indexes roll too.
No, I agree. And I love this chart because it's most of the time people just think the opposite, where and we're traders, right? Like that's the thing about it. Like, sure, you're a long-term investor, you want to buy a crash and you're going to keep dollar cost averaging, whatever. Fine, great. I think there's better ways to do it, but that's, you're most of the general public, that's fine. There's nothing wrong with that. However, if you're a trader and you're trying to gather momentum, and also you have to understand you're not going to be willing when the market comes back against you to continue to just hold that position. So to do that, how do you do that? Well, you need momentum behind you. You need the pullbacks to be shallow. And what you're seeing after the market makes new highs, most of the time the pullbacks are shallow. Some people will say, well, you see right there, that's when the last high happened and then the market crashed. It's like, yes, of course, at some point it's going to be the last high because that's how markets go. But most of the time when it's a new 52-week high and it hasn't happened in a long time, that's when you get those major trends beginning. It's the same reason why, the oldest, and this is kind of funny because I don't think many people think about this. One of the oldest trend following systems is so markets have changed over time. And it's not that they've changed in a way that's like they don't trade the same. They change in a way where it's systems that worked back then will not work today.
Yeah.
For example, Richard Donchian had a system which was 20-day highs.
Yeah.
You buy 20-day highs, you sell 20-day low. You try to use this system now, you get chopped up to death. You want to just shoot yourself. It's a miserable system to use. But if you change that over time to the turtle traders did 50-day highs, 25-day lows to sell, and then they did 100-day highs, 50-day lows to sell. So buying 100-day highs, selling a 50-day low. And then as the years move on.
Why did they change, Jason? Do you know?
Why did the markets change?
Why did they go from 50 to 100?
So they went from 50 to 100. One, they actually had two different systems. So the turtles had two different systems. Yeah. And then, but over time, most of the turtle traders, if you talk to them, one-on-one or have a conversation with most of these guys, they'll tell you that the shorter term systems stopped working very well at a certain point. For example, the shorter term systems for a 50-day high and selling a 25-day low would work well in one environment that happened recently, which is 2020, 2021. Yep. You can make a lot of money with that system, but it's not consistent over time. So what you'll see is they go to 100-day highs was kind of their more longer term system. Most people use two different systems or three even, sometimes 20. There's a lot of different systems most of these guys have. But you'll see what happened over time. Jerry Parker, moving to 200-day highs, selling 50-day lows. There was Larry Hite did 52-week highs. So basically there's all these different ways to do it. But what you see is over time, all these guys move to more longer dated strategies because those are actually more profitable in the long run. So you'll see that they keep moving their time frame, and that's very interesting to just kind of think about for what we're talking about right now, which is the idea of buying new highs. The one thing you learn from back testing is that sometimes, especially if you're in that time frame, people think they're too late all the time. They're not. Most of the time, if you buy a high that's up there, it's the same thing as like you see. There was what was a recent 52-week high that happened? Or even a 100-day high. Natural gas makes a 50-day high, then a 100-day high, then it starts to run like crazy. Most people would say, I wanted to buy it when it was crashing, and I wanted to buy it down here. When it was crashing, you're going to shoot yourself because it's a miserable trade. You're getting chopped up to death. It's up 5%, down 10%, up 20%, down 5%. Like You're going to just drive yourself crazy. So waiting for that 50-day high or 100-day high just kind of gives you a little bit more of a momentum behind the move. And also, yes, they're going to come back sometimes. Like you can't have tight stops. Like breakout trading is incredibly hard. Kevin and I talked about this on Monday about how ridiculous breakout trading is, and it's not for everybody. However, that's how trends happen. Trends happen when you make new highs.
For sure. What's up, Kevin?
What up?
Hey, what's up?
Dude, I am struggling today.
I want to hear what
I'm just going to say that right now.
about the Fed and the inflation.
What'd you say?
What'd you say, Steven?
I would love to hear Kevin's thoughts on the Fed and the inflation.
Oh, that's struggling too. No. No, yeah, we had some data prints this week that were obviously favorable when it comes to the inflationary picture. That disinflation narrative is starting to kick back into effect, but I still think that we'll have a little bit more time. I think we kind of talked about this on Monday. We've had 5 CPI prints this year. 3 of them been hot. One's been kind of stagnant, right? And then another one's been cool. So if you kind of look at that overall picture, you can't really say disinflationary trend is really back into effect in full force until we get more data. And I think that's what the Fed's going to really rely on. That being said, I do believe that I don't think they should yet. And once again, the market's already getting ahead of itself when you're looking at the 10-year treasury yields sitting at 4.2 now. I was at 4.198 earlier this morning, which is remarkable. But I think the Fed's going to utilize this base effect window that we're going to see in August and September in order to justify a September cut. And I think that they're going to hold out for the remainder of the year, maybe try to do a cut in December. If not, January would start that cycle. And then for next year, January, looking at basically quarterly cuts. I think that's really the plan that they got at this point in time. So good. We had some good. So the PPI data yesterday, I think, is a really good one.
Was that cool too?
Yeah, that came in really cool. But the thing is like the majority, 60% of it was energy. So we have if you could, we're seeing top line numbers improve, but when you're looking at the internals, it's not as rosy as the market's kind of projecting it to be. And so just having progress on the energy front alone is not going to get it done. You need to have progress when it comes to some of the stickier items. Now, auto insurance came in a lot lower than the street's expectations. Actually, it was a deflationary pressure, a 0.1% or 0.2% for the month. That's something that has been running hot here. But I think we have a print. We're on the right track, but we're just not there to declare it yet. Here's the thing that I want to say concerned. Just keep your eye on this. The initial claim data is starting to accelerate as far as the rate of change. And so if that's going to be a trend and we start hitting 250,000 and we hit 250,000 in 3 consecutive weeks or 4 consecutive weeks, that unemployment rate is going to jump, and that's going to overshoot the Fed's target there. Is that going to be enough to move the Fed? Who knows? But I don't know. I still think that we're not going to cut in July, in my opinion. I think we may cut in September. I don't think they should, but I think that's when they're going to cut.
So you're saying the market's getting ahead of itself. I think the major averages, the large cap weighted indexes, maybe are getting ahead of themselves, but they're masking the real reaction, right? So if you look at since Wednesday, something like ARK or small caps, they're not reacting positively. To the Fed or inflation, right? They're calling bullshit. Sure, the NASDAQ 100 has been a straight line higher since Wednesday, right? And looks good, but that's not really telling the story. If you look at the most interest rate sensitive areas, I love speculative tech for that. Something like ARK. I think small caps are good. I think banks are great for that. They're not buying it. They didn't like the news from Wednesday.
Yeah. What I meant as far as getting ahead of itself is the yield market. So
Yeah.
10-year and 30s, I feel like are getting ahead of themselves when it comes to the yield. I mean, look, and this is I feel like the messaging from the Fed actually does more damage than it does actually help. Like they have to understand they have to talk tough to this market. It's kind of like a 8-year-old, right? That they feel like they know the world. It's like, they feel like they know the world, but you kind of got to be like, look, this is not how this thing works. And if you get ahead of that way too early, you loosen financial conditions, and then that's when we have the resurgence of inflation. There is no magic equation to this thing. I think people kind of like bring all of these things, and sometimes I do that myself. We talk about all of these different dynamics and PPI, CPI, PMI data, and all this stuff to kind of like, it's real simple. The easing of financial conditions encourages spending. Encouraging spending creates demand. You create demand, you then have demand for supply, and then that's when you have prices rise, right? That is the key area. So when I'm looking at the 10-year and I'm looking at it at 4.2%, almost 4.19%, I kind of think to myself, how much lower can it go? How much lower can it disconnect from Fed funds if we're not going to get a cut? If we may not get a cut this year, now maybe we do, right? September, maybe. But if we don't get that September cut, man, the re-rating within the 10-year treasuries going back to 4.5%, I think is something that we need to keep an eye out for. That's just my 2 cents on the yield market, at least.
Yeah.
No, I like that, and I think it's the market, and what Steven brings up is a good point. And I brought up a chart. This just over the last month, and you'll see ARK is moving down. Basically, on the day on Fed Day, ARK started to move down, the XLF started to move down, the KRE started to move down, and tech is the only one to continue higher, and it's kind of lagging. It's not keeping that same momentum behind it at the moment. Which here's the hard thing about what we're all going to say, and this is where the struggle gets real. Is last year, for example, we could talk about the Mag 7 and the run that we had in the Mag 7, how good the Mag 7 looked, and the rest of the market looked like crap. And we could say, hey, this could keep going on for a lot longer than any of us could dream possible. I think that's something that needs to be said, is like, I don't know how long this whole a few stocks hold up the market, or the NASDAQ is the leader, especially the XLK being such a major outperformer. Like, I don't know how long this can happen. However, because Kevin and I will go on another thing once in a while, and the guy will talk about breadth not mattering. And I think that's a ridiculous statement. Like, it of course matters. But in a way that the S&P is so concentrated in these big names at the moment. The Qs are so concentrated in these big names at the moment. These things do go on for longer than anybody's expected, but they do end at some point.
It already has. Like you said, we were saying this last year. How long could this go on? It's still happening.
Yeah, it's still happening. And like, I think it's important to know two things. One, this can keep going on for the rest of the year. It's completely possible. But there's also the other piece of it, which is this is the environment where most markets start to end. You start to see breath fall off. You'll see 2018 is probably one of my favorite examples, which is when you had what did we call it back then? There was another name. It wasn't Mag 7. It was Fangs.
Fang. Yeah.
The Fangs. I almost forgot. It's been that long ago. Jesus.
Like 2 days. Yeah.
It's been a couple days. But the Fang stocks back in 2018 were the rage. Same thing, kind of the Mag 7. You add NVIDIA and add Tesla to it. And so what we basically have here is we had Apple moving up, we have Amazon moving up, we have the strength behind Facebook, we have Netflix is another one, and Google. So all these things are kind of holding up the whole market at that point.
I think.
And then go ahead.
No, go ahead. I'm sorry, man. You're lagging for me. So.
Oh, no worries. Then basically we have some of these start to fall off. One at a time. Then we have Facebook falls off first. It was an earnings day. It goes down 20% on earnings. Snapchat was all the social media went behind that, which was Twitter and Snapchat. So those start to crash as well. So basically that crashes. The next thing crashes. Amazon starts to fall. Apple was the last one to fall in October of 2018. So basically what I'm saying here isn't that the market's going to crash. I'm saying that we have a clear signs to see what could happen. If breadth is very thin, start to watch all of these leaders. When they start to break trends, then you go, okay, well, now the market's getting a little weaker. Okay, Apple's falling. Now the market's getting a little weaker, and so on. So when they start to break trends, just pay attention to it. Not saying it's going to happen. I'm just saying that would be my signal to say, okay, something's changed. Because you can't just look at the breadth.
Bear. He's a bear. He's a bear.
I'm a bear now. Yeah.
Oh, dude, no, I'm right there with you. Yeah, I'm a bear. Look, I think exactly what you're kind of talking about, right? The concentration risk is uncomfortable. I think that's all everybody's really saying, because somebody will take that statement and say, "Well, he's a bear." No,
I'm still wrong.
It's the concentration risk is what makes it a little bit concerning. But I think we need to start looking at sectors in a risk reward basis, on a risk adjusted basis, right? Because if you kind of do that and you kind of look at some of these sharp ratios, you can kind of make a case. Okay, maybe defensive sectors, they're not going to rip 5% in a day or 2 days, right? But they might rip 1%, 1.25%, and that magnitude of a move to the upside is the equivalent of something like what an Nvidia will do, or what a Tesla will do, and things of that nature. And I think the risk appetite, people should never forget that. Right? FOMO is when you put your risk parameters to the wind and you try to follow everybody else. And yes, that might be profitable at some point, right? Every once in a while, but you never want to feel uncomfortable with your trades, because that's where you don't sleep at night when you have uncomfortable trades putting on your in the market. But I still think that there's areas of outperformance, or areas where you can park your money in the market that still maybe even does have exposure to AI. We had this conversation on Spaces the other day, and we had somebody make a comment, like you got to get into these names directly, right? You don't get into AI names by just doing ETF. That is an absolute absurd notion.
Yeah.
That is an absurd notion to come out and say the SOX ETF, SOXX, which is not it's more of a balanced semiconductor ETF name, right? Compared to the SMH. That thing still has a 33% return on a year-over-year basis, or on a year-to-date basis, knowing that you have the diversification. And who's going to be mad at 30% returns? No one. On a year-to-date basis, we're only 6 months into this bad boy. Let's say it even pulls back 15% on a longer-term time frame. That might be comfortable for somebody's risk parameters. If you even got to the SMH, dude, I forgot what it was, 55%, 60%. So you don't have to get into the names directly. Diversify that concentration risk out there. If you think dollars are just going to get thrown into this sector over the next 10 years, which it is,
I couldn't agree more.
You can diversify and still have the exposure there. You don't have to be Nvidia. You don't have to just get into AMD. I'm not hating on those names, but if you're following somebody that's saying the only way you can win in the AI trade is if you hit the specific stocks, I call BS on that. Diversify the risk. Concentration risk is a real thing. It's a real thing.
Like, we're all for picking the strongest names, right? We love relative strength at all-star charts. But you know what? Arguably the best vehicle for AI has been this cycle? In the NASDAQ 100. It's hard to pick the right ones, okay? But it's all the mega caps. Those are the guys who are winning. Right? And we said this a year ago when it started happening. Who's going to win from AI? I would tell my friends, the same companies that won from the last tech cycle. It's going to be Google, Amazon, Meta, Apple, Microsoft, all the big ones. No one wanted to hear that because it's not sexy. They wanted to buy that AI, that C3 AI or something else, weird or obscure. Just go with the big boys. They are so well positioned to take advantage of this trend. And if you want to spread that risk out, go with the NASDAQ 100. It's going to be driven by the Mag 7.
Yes, I agree with you. Diversification, I mean, diversifying and still having exposure to AI I feel like, is the most prudent thing. Will you give up alpha? Yes.
Listen, go buy a super micro, right? Make a little sleeve in a super micro or Dell or something else. Go for it. Own the NASDAQ 100 for this theme. 100%.
Agreed.
I think that's funny. I mean, once again, and Kevin, you know, I've had this conversation with that person before. It's the same thing. It comes up again and again, and it's kind of funny because it's like these years I've had a fund for ETF specifically, and I have this argument constantly. It's the same exact thing. What do you think of this? How exactly does this work? You know, you use ETFs. Here's the thing with ETFs. Yes, if you look at it at a certain point and you say, okay, this stock is up 50%, my ETF's up 35. When that stock goes down 25%, the ETF's only going to go down 5%. And so most of the time, you're going to have outperformance using the ETFs. It's a smoother return. You're not going to get shaken out of as many things. Like so many people, like they look at it and they're like, oh, well, you know, I want to be in NVIDIA, for example. I would have bought NVIDIA 20 years ago, or let's use Bitcoin. Everybody knows what Bitcoin looks like. Bitcoin going from $1 to 60,000. Everybody, I would love to hang on to that. You would have had to hang on to 80% drawdowns. You would have had to keep your conviction during those things. Some people think they could do that. Most people can't, and they will sell at the wrong time. But if you had the ETF, it'd be a lot easier. Something diversified, you know, something that's in more than just one name.
The only people, Jason, who were in Bitcoin at $1 and are still in it are the ones who lost their wallets.
Yep, I got a couple of those friends.
I know one.
Yeah. You know, people lost their wallet. That's the truth, and it is. And so basically, if it's a situation where you forget about it, you can do that, sure. Or you know, like you have your my grandmother, for example, was a put money in my account and never look at it. You know, like. Sure, you could be one of those people, but we're traders. There's no reason like we shouldn't be talking about that or talking about those things because we're traders. So I think as a trader, the easiest thing's going to be something like the SMH, the Qs, you know, the SOX, something diversified, small. You're going to get the outperformance without all the headaches. And to me, the earnings risk is part of the reason why I don't understand earnings to some crazy level. I don't think anybody does really, if I'm being honest, but people pretend to, and they go, I know the stock will go up if this happens. I know it'll go down if this happens. Most of the time, you don't know. People react to things in different ways. You don't know what somebody's going to say on an earnings call. So for me to really take advantage of those trades, the ETFs, the indexes really kind of help me to do it as a person who really doesn't like the earnings risk.
Yeah.
And if you have something like so we talk about sector rotations all the time, right? You get into defensives and you go to cyclicals and all that stuff, but you can have industry rotations within a sector, right? You have different companies within the same sliver. So let's say NVIDIA, for whatever reason, slides 5% because there's a report out that AMD has the next best thing for whatever reason, right? And AMD pops 15%, NVIDIA drops, let's say 5%, 8%. Well, once again, you kind of go back to that ETF theory and say, well, if my dollars are just churning within the product, I mean, you will have weightings will matter, right? But if you have dollars just churning, and those dollars aren't really fleeing the space or fleeing the theme, but they're just kind of churning between the top 2, 3, 4 players within the space. Once again, you have that exposure. And I'm not trying to like sell anybody on this. I'm just saying you don't follow the herd all the time because the herd is gonna burn you, especially for individuals that might be, you know, have a vested interest in getting you to buy something or to sell something here. So that's my soapbox on that, man. Yeah, you guys have any other things you want to follow up on that one?
No, we don't need to follow up on that anymore. We said it. I think that was a good thing to bring up, though, because I think traders, they run into that conversation a lot, and they feel like, one, if you're an individual stock picker, great, go do that, be awesome at it. Not saying that it's good or bad. I'm just saying that I don't do it. There's reasons for both. There could be outperformance in one area. There could be underperformance in another area. But I am just saying that most of the time, the smoother, as you learn to trade, the thing with the smoother return without the name that you're going to get married to will probably make you a better trader than anything else.
Let's transit. So you brought up financials. Somebody did.
Yeah.
And that's one of the areas where where I say, how much can yields go lower?
I know.
Right. And really, because we are seeing a break in correlation right now. Soapbox real quick. All right. So we have the dollar actually gaining some strength, but we have to kind of keep in mind too, it's fundamentals based on macro, right? We had the BOJ, we had us this week as well. We're seeing that trend or that churn, but also kind of keep in mind there's some political things that are happening out in the UK that has created the pound to be a little bit weaker, which is strengthening the dollar, and then also in the EU, specifically in France, the political, I'm not even going to call it turmoil, but the adjustments that are going to be taking place over there, snap elections and things of that nature, has weakened the euro and gone to the dollar as well. So, if you're looking at a chart of the dollar and you're just kind of taking it from a high level view and you only look at the US data, I feel like you're going to get faked out a little bit. There's probably a buck in that dollar index right now that's just geopolitical related just in itself. And then once that kind of levels out, that's probably when we'll start seeing the dollar actually make its true move. It just happened that the stars aligned when you're looking at the dollar. But the banks, especially regionals, yes, we went from 3 rate cuts down to 1. I don't think that should have been a surprise for like anybody in this market. Like whoever was still pricing in 3 rate cuts this year and was in a regional bank position and would sell that because the dot plots changed to 1 is asinine to me. But I think it signals the fact that if we're not going to get these rate cuts, and even if we have lower rates on the 10-year and 30s, which is going to kind of synthetically boost demand when it comes to loans, and you still can't catch a bid, I'm a little concerned about that. I don't think that I was in the camp of, hey, man, KRE ranging out is not the best thing, but you could make a calculated play on regionals, especially with the KRE. I don't think there's a regional bank that has more than a 2.5% weighting within the index, very diversified.
Yeah.
But I am getting a little bit concerned now because why would you fade that move knowing that the market might be offsides on the yield side? I don't know if there's something else that's there. Steve, what do you think?
I think you're absolutely right. Looking at this range in the regionals that they've been in all year, right? They had a great Q4 last year and have been dead since. If these range lows break, and I think you can err in the direction that they're likely to, because the relative trend, if you look at KRE relative to the broader market, lowest level of all time, right? And the relative trend tends to lead and tip us off the absolute trend. If those range lows go, market's probably telling us we're going to lose some more banks, I would imagine.
And there's another problem, maybe.
Yep. Right.
Yeah. Because that doesn't make any sense to me, right? Like you would still at least have the optimism of being like, okay, we're going to get something, right?
Yep.
And then if the regionals don't hold, I don't think small caps won't hold. That's just my two. I care less what anybody says. You can have GME ripped to the moon. You can have Carvana ripped to the moon.
Yeah.
You're not going to have sticky flows. You're not going to have sticky institutional flows without regionals and not without that earnings power.
If the regionals go, what's gonna save small caps? Not gonna be biotech. So
yeah,
real problem.
And it doesn't look like it's going to be industrials. I mean, industrials have been doing really good. I think Steve, you and I actually talked about this maybe a month ago or so. When you're looking at the mid cap industrial names, small cap industrial names, relatively they were doing all right.
Yep.
But I think once you did have the re-rating or the rate cut adjustments being moved to the downside there, I think you are seeing some fear when it comes to a lot of these domestic players, right? Not the ones that have international exposure, but just purely selling from Illinois to selling to Ohio, and that's their business. It seems like there is a little bit of concern to that. And you can see that today, industrials, materials, consumer discretionary selling off.
Yeah. So
energy selling off 1%, and crude wasn't down that much. I mean, it's been ranging today, but it seems like there's a.
So it's interesting because yes, you're right. There's big differences when you move along the cap scale for some of these sectors, like even technology, super strong large cap basis. Small cap world ranks around the middle right now. So we run the rankings every Friday, our sector and industry group rankings. So the numbers I'm about to quote are stale by 4.5 days, right? And I think they will change. But even coming into this week, Kevin, materials and industrials were the two strongest groups in the small cap space. That doesn't mean they're doing well on an absolute basis, but they're at least outperforming peers. I think that's going to change a little this week. You're getting a good amount of give back here from small cap materials, even just today. So we'll see where they come in next week. But coming into this week, that was still the case. So you're having this strange like bifurcation where it's like, okay, if we're buying tech, we're buying large cap tech. Okay, if we're buying materials or industrials, we tend to be going to the small cap ones. I don't know if that changes or not. I also like what you said about the politics, because I came in at the top of the video today. I was like, Jason, we got this little short-term divergence between rates and dollars. Do you think that's explained by the geopolitical stuff and the election stuff?
I think so. Not our elections. That won't price in until like August.
Yeah.
You know. But yeah, I think and then when you're looking kind of at France, it's a powder keg there. Like it's been one for what, 8 years now, 10 years. We've seen the videos there. It gets a little rambunctious to say the least. So what will happen? Most likely, the snap elections most likely will fail for Macron. He will not back out, but he basically won't get any domestic agenda done that he wants. With the structure that they have in France, he's still going to get the geopolitical things that he needs to have done, right? Everything that's outside of his country, like support for Ukraine, still going to be there. If you wanted to do all that other stuff, it's still nothing's going to deter him from that. It's not like the US where Congress can kind of do their thing and intervene. But I think knowing that they're going to have that gridlock, knowing how quickly the shift was, this actually, no one had this on their radar. And it's not only just France. In the UK, it happened the same way, right? And I'm not going to say far right, ultra right, blah, 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 whatever. But you're seeing the shift a little bit more aggressive than what we would have maybe otherwise assumed. And I think that uncertainty, knowing that we have more elections down the road here, not just us, we have other countries that are going to go through it. And if we see this whole paradigm shift actually occurring, that's going to strengthen the dollar regardless. People kind of feel like, you got the people that are like, oh, like the dollar is losing its way in the world. Like complete BS. Like the dollar has been strong as hell over this whole run over the last 3 years. And people continue every day, oh, the dollar is weak, dollar is weak. No, it's not. No, it's very strong. You want to actually see a weak dollar to a point, though, right? You want to see the dollar index kind of maybe go down to 95 gradually over the next 2 years, 2.5 years on a gradual scale, because then that'll boost manufacturing numbers and manufacturing demand. That's when your multinational industrials are going to start killing it again, like Caterpillar and Deere. That's going to be like the what you want. But yes, I would say. And no one can put a dollar amount to this, guy. So like, don't call me out like, oh, we're trying to. I would say maybe 1 point of this dollar index move that we've seen this week is based on geopolitical, and that you could actually kind of see that by the price action of the dollar overnight when these events are actually occurring, right? And when you see those spikes in the dollar, they're not fading. That's where you can kind of get that price premium in. So maybe the dollar, we've been talking about this wedge pattern kind of taking form, or whatever you want to call it, right? This asymmetric triangle, right? Maybe we hit 106 again, but this thing's coming to, I mean, if you look on a weekly chart, we're 3 weeks, 4 weeks, Steve, till we're at the apex, baby. And we're either breaking up or we're breaking down. And that's what I'm going to be looking for. And if you kind of think about that, it's not going to be 2 weeks, 3 weeks. It would be more like 2 months if you kind of break it out. 2 months from now, we're in what, August?
Mm-hmm.
What's in September? Right? So that's Fed meeting, right? So that's kind of what I'm looking at. And then the August and September timeframe is when we're going to get the political movement within the dollar as well. And then it won't be, let me not say that because, dude, anything's possible in the U.S. Right? Like, let me not.
So remember, Kevin said the exact number what the dollar's going to hit, so everybody should write that out.
No.
Kevin is wrong. Make sure to send him as many emails as possible.
Traditionally, what we are seeing in the VIX curve, what I'm trying to say is what we traditionally will see in the VIX curve is October VIX has the spike, has the implied move of election risk that's priced in. The November VIX does not, even though we have elections in November, because polls usually will be tight enough for the market to understand where everything is going to go. Not only when you're talking about the executive branch, but also the legislative branch too, right? Yeah. If that's going to be the case this year, I would suspect that reaction or that same type of complacency would be reflected in the dollar, and that dollar move, however it shakes out, would then be priced in around that same type of time frame that the VIX should have the volatility spikes that we should see in the S&P 500. Hopefully that makes sense, right?
Yep. I
Probably
think
won't happen that way.
right now, and really since last year, all of last year, from a technical perspective, we're sitting here in 2024 and we're saying, oh wow, dollar's been moving higher all year, but stocks have been fine. Wow, how resilient risk assets are doing fine in the face of a rising dollar. I don't think the market's going to blink too much and price in dollar headwinds or dollar tailwinds until this range is resolved. So if you look at the DXY, you could draw a very clear resistance zone and a very clear support zone. You have to draw through like a blow off peak and blow off bottom on each of them, but it comes in around 101 the lower bounds, and I got it drawn at about 106 3/4 at the upper bounds. That range, as long as it's intact and Dixie is somewhere in there, I don't think you're going to get too much movement or panic from risk assets. If that range resolves to the upside, right, then the primary trend is turning higher for dollars, and it's probably going to weigh on risk assets more in the future, right? Then the market starts pricing in even higher dollars once that primary trend reverses and that range is resolved. Then I think it could be problems. But for now, we're just kind of, dollar's been sideways. Until it really takes a direction from a primary trend perspective, I don't think you're going to get much in terms of, a bid for risk assets or weakness in risk assets from it.
Yeah. And we have a secular trend too, which makes it very difficult. So people, last year, everybody was like, oh man, look at the S&P 500 is going up. Dollar is also going up too. And it's like, dude, that's not usually the correlation.
No.
Usually have the opposite correlation. But if you have a secular trend, something that's going to be a new industry, a new market, right? A new horizon, that secular trend could care less what the dollar does. It could care less what's happening over in Ukraine. It could care less about banks failing. It could care less about any of that stuff. And that's what we kind of saw last year. And now we kind of got lucky this year. For the most part, right? We kind of got lucky because it has been range bound, so it hasn't been a shock.
But it's been higher in that range. It's been moving higher this year in that range, the dollar.
Yeah, but I mean, on a relative basis, it hasn't been as aggressive. I mean, this is probably the least volatile or average trading range on a weekly basis, if you look at a weekly chart, that we've seen over the last 3 years, 4 years, right? So this is kind of tame. And what I was going to say is markets can deal with stability in whatever product that's out there, right? A market adapts all the time. If you have a dollar and the dollar ranges out just like it's doing, if it continues to do that throughout the whole year, I mean, it's not going to be a problem. If you have a dramatic move in the dollar to the upside, that's when you change. And that's when it becomes a headwind. If you have a dramatic move to the downside, let's talk about that. That's also a problem. You don't want to have volatility in the dollar. You want to have a gradual trend in the upside or downside. Same thing with yields. Can the market sustain itself at 4.5% 10-year treasuries, or even a 5% treasury, or a 6%, or an 8%, or a 10%? It can if it remains there and the market then adjusts and adapts around it. That's how markets work.
And there are every now and then secular forces that are just far stronger than anything that the inner market's going to throw at us.
Exactly.
And I think, like, that's what you're seeing a lot this year. We're talking about, breadth is thin. It's just the AI trade. Yeah, it's the AI trade. It's the secular theme here, right? Just ignoring dollar strength and rising interest rates. I'm with it.
And also, you guys talked earlier about the regional banks, and if you wanted to know how old school of a trader I am, just look at the diamond pattern that I drew on here. That it's the most old school pattern in the world, but it still creates tops and bottoms. It's basically just a head and shoulders, just a little bit wonky if you want to just call it that. But looking at the regional banks, like you mentioned earlier, and looking at rates and looking at everything we're seeing. The curve really has to widen out here for the regional banks to actually start to do better. Also, oil would need to start to move up here. All of those things would really help the regional banks, but maybe regional banks are saying that environment isn't right. Maybe
it's not.
Yes, exactly. And so it's just not saying that. And that most of the time, that's what you want to look at with the price action. It's not that the price action is going to tell you the future. It's that you want to look at it to give you hints of what's going on. Is it confirming my bias? Is it not confirming my bias? The one quote that I always love in Jesse Livermore's book, not his book, but written by Edward Lefebvre about Jesse Livermore. The book, the great part of it is that you pay a premium for the price action to confirm your bias. Meaning, breakouts are that premium that you're paying to confirm your bias. So it's the same thing as like you see a bottom, like you'd love to just buy like the dollar. We had that chart of the dollar up. Put it back up to cut mine and Kevin's head off, and you can see our foreheads. It's fantastic. But if you look at this chart and you go, okay, well, there was 2020 and the dollar crash. You would have bought that crash 7 or 8 times before that really hit the bottom. The right way to do it is to really wait for a signal. Maybe a new high that happened. I think the 100-day high happened in 2021. And then really you got a nice trend out of that after that. And that's how you kind of pay the market for that premium. But once again, what I'm saying is you can also use that intermarket analysis going, well, the regional banks are saying that this isn't happening. The regional banks aren't saying that oil is moving up or that the long end of the curve is going to start to move higher. So all of these things you kind of put together and go, okay, here's my template for what I'd like to see going forward. I personally think, and I recommended it the other day, and I told you, Kevin, this is going to happen because I'm price action based. I'm sitting there going, bonds suck, bonds suck, bonds suck. And the second I start to get a signal, I'm going to go, bonds are great. So we bought the 2-year bond recently. It could start to move across the curve. It's not there quite yet. We're not seeing anything in the 10-year or the 30-year just yet. But both of those actually went neutral. So we went from short to neutral on those very recently. We've only had one buy signal one neutral signal since 2020 in the bond market. So that's pretty significant.
Why do you like the short duration over the long duration treasuries right now?
It's not even a preference. It's more of the fact of signal, at the moment. But once again, it's going to, most of the time, this is how the end of the cycle usually works, is where you start to see the short end of the curve start to move, and then the long end starts to follow it. So I like to be on the short end coming out of these cycles. I think it's kind of the easy trade. It's hard to do for normal traders because there just isn't an instrument to really trade it well. For me in futures, I have the perfect instrument. Futures trade those very easily. But as a retail trader, you're going to try to buy the SHY ETF or something, and that thing's not going to move at all. And you're going to go, what the hell is this? So I think options on something like the 2-year note, leaps on those would be probably a great trade right now. Pretty easy. The price is right. I think it's probably a good trade. Going out further on the curve, I can't really say anything just yet, but I am saying it's neutral, and that's kind of interesting considering we've been short these things forever. There's been one signal that happened out of October bottom, and that was it. The rest of it's been short. So now we're neutral on bonds across the curve and long on the shortest end, and told Kevin it would happen, and here we are. Not as I was predicting it, just telling him how I will go from bearish to bullish in 5 seconds, because once the system changes, and that's how you trade. You don't trade by having a rigid view of like, I know this is going to happen, therefore I need to be short bonds forever, and I don't care that because that's the thing. A lot of people get wed to positions. Shorting bonds was a great trade for a long time. It made a lot of money for us. Even in bad times in the market, it really kept our returns going very well. It'd be very easy for me to say, I love that trade. I'm going to stick with that trade forever and ever and ever. But you got to change when the market changes.
It's no different from, the conversation earlier where we're saying, don't fall in love with any of these AI stocks. They're going to be great. They're going to be really good, but don't fall in love, right? Don't marry these things. Mm-hmm. Don't fall in love with a bearish idea either. Don't be dogmatic in your approach. Mm-hmm. Remain open-minded and flexible because the data changes. New data comes in, we change our minds. And that's a nice thing about being a technician. So easy to change our minds. In fact, if we're not changing our minds out here all the time, we are some awful technicians.
Exactly. It's the thing about levels and price action and everything that's important. Like whether you're systematic like myself, whether you're looking at the charts every day like Steve, like however it is, and Kevin also, that's the thing that's kind of interesting about Kevin and why I was like, damn, this guy really knows his shit, because we would have conversations about like commodity fundamentals, and then he's talking to me about price action levels. So everybody on here looks at charts, and honestly, every single person I've ever met who's a good trader, who's talented at this, they all look at charts. And so as we all look at charts, we see levels. And if we're all looking at levels, when those break and those change, we have to be able to change our mind, because guess what? We don't get paid by thinking, well, I think the inflation is high. I think the Fed is, they're never going to raise rates. So I'm going to stay short this and I don't care what the signals are saying. The price action is how we get paid. It's the same as, and we could talk about this before we get off, Kevin, copper. Copper hit our levels, started to break down, get hitting stops, hitting sell signals. So what do you think about copper, Kevin? I know you mentioned earlier that you wanted to talk about that a little bit before we get off.
Yeah. Hey, I sent you a chart. Can we look at that chart just real quick? Yep. And then by all means. Oh, wow, we're waiting for that. So copper, I mean, this is a tough one for me. It's very tough. Look, speculators have gotten washed out. It's trying. It's like a weird, on a daily chart, weird head and shoulders, like a very compressed head and shoulders pattern, right? Now, the 450 level is what we've been kind of like looking at and seeing if it's going to hold. For the most part, it's holding. But we are starting to see some cracks to the downside, and then it's like recovering during the U.S. equity session. So right now, I feel like the chart's going to fail. There's nothing else that I can say about that. I think it hits the 200-week moving average. I'm a weekly chart guy. $4.26. Let's say $4.27. You got to be a little bit more precise when you're talking about copper because of the dollar action there. But I think it does fail that gap range that we kind of highlighted the other week, which we can kind of see consolidation. Now, that kind of goes against the thesis of usually this market. If we see one of these bull runs, usually for copper, it's like the only contract I've ever seen do this, or any stock for that matter, that actually triple tops. Some people say triple tops don't exist. In copper, it does on weekly charts. So maybe this is the first flush. I think we test down to $4.26, $4.27. I think it's going to try to push higher. But without that speculative flow, it becomes very difficult. We already have a lot of inventory and supply actually hitting the market this month, which is another reason why we kind of saw this pullback, and another reason why producers just did not participate in the move past $5. And so speculators are just getting washed out right now. And if we have this situation where industrials and materials are starting to sell off, and there's this notion that we might have a pseudo slowdown, it's harder once again to kind of give you the theme for copper. And I just find that very difficult. Only curveball, and I'm not calling out a geopolitical thing, but honestly, I feel like we will see an actual physical kinetic escalation between NATO and Russia. I'm not saying that to just say that. I'm saying that because it does not look great on both sides what they're doing right now. We just had I just had the company that just cut their contract, Unifor. They just cut their contract with Russia, Gazprom. I mean, there's a lot that's happening underneath the surface that if we have a disruptive event, especially when it comes to Russia, Ukraine, NATO, what have you, I think that could tip the scales for your super cycle that I hate calling stuff super cycle. I hate, Steve, if you would know anything about me, when people say super cycles, I hate it. I hate super cycle.
It's a good one.
I feel it gets very abused.
Kevin actually always says super cycle, hyperinflation, like every conversation we have.
Hyperinflation, right? So I think that's my biggest.
I've never heard you say it, actually.
Make sure you call this video the super cycles for the SEO.
I hate it. But that's my biggest concern when you're looking at the commodity space as a whole. Like right now, I think a lot of the speculators are washed out, but I feel like there is something there right now. I mean, you got Russia and Cuba right now doing military drills. Like, who does that, right? Like, this is something that is a little bit serious. If that were to be the case, I think the metals, and I also believe the gas or natural gas would be the ones to pipe. And actually, I want to spike, and I wrote a piece about that, and I dropped it like maybe an hour ago or 2 hours ago, where LNG demand, dude, is so off the charts right now because of the increase in demand, especially in the Asia Pacific markets. Japan, South Korea, China, and they actually are trading at around a $3.10 premium per megawatt hour on LNG right now. So what's happening? all those LNG, we don't have that much LNG out there. It ain't like they're oil tankers. Like you only got a few, and they're basically going out there. They're on their way, and then Asia markets say, "Hey, we'll pay you more." Boop, diversion, and they're diverting these things over to East Asia. And the problem that you kind of have there is now the European Union, if you're looking at their inventory levels, they're actually lower than where they should be. Now we just started a refill season, but natural gas in the UK, or if you're looking at the Dutch contract, spiked over 32% in a matter of 3 months. And I believe it spiked over like 10% in just this week alone. And it's a volatile product. So I just am keeping my eye out on that fact there. I'll kick it back because I went a little long.
No, I want to expand a little bit on the technicals you were talking about with copper, right? So you're saying you're feeling bearish looking at this chart of copper. I mean, here's the problem. When you make a new high like this, start to break out from the, this is in the case of copper, multi-year range that began first half of 2021. This is a failed breakout. And what tends to happen with these, from failed moves come fast moves. So this has downside potential all the way to the lower bounds at this point. Like you said, like it knocked on the door once, it knocked twice. We finally thought we were getting the breakout. Everybody piled in. Everybody loved copper a few weeks ago. Smashed, right? So this, for me, has some big downside risk right now to the lower bounds. Now, copper stocks are no different. I always want to look to the equity. Is the equity market confirming and supporting what we're seeing in the commodities market or not? It's the same exact thing here. And I brought the weekly MACD in the lower pane too, just to show momentum rolling over in a big way as this failed breakout's occurring. You could draw this chart the same exact way.
Yeah.
Breakout looked fantastic for a few weeks, really just getting smacked down back into the box. And now the risk is all the way to the lower bounds of these ranges. So not great.
Tell me if that MACD fails you.
It fails all the time. Fails all the time. The MACD, but the weekly is going to be a lot better than the daily, and then the monthly is going to be even far better than the weekly.
Yeah, I'm saying that copper actually does respect MACD actually pretty well if you're looking at the longer term trends. I'm saying the crosses, 12, 26 crosses tend to be pretty decent.
Yeah, look, you had one here at the upper bounds in 21. We had one again at the upper bounds in 2022. So yeah, it has been really good. You're right.
And we're about to cross it right now. I think we actually did cross it. If we're not crossing, we're pretty close to it.
Yeah, we like the weekly MACD. We love the monthly MACD. It's a little slow.
Yeah,
far less false signals. The daily MACD 12.26.9 is just noise, dude.
Yeah, agreed. Hey, somebody put a comment in regarding hurricane season, and that could also boost commodity prices, probably especially when you're talking about gasoline and natural gas. Yes, that's a good call out. And then if you're looking at the reason why we actually saw natural gas move to the upside is a couple of reasons, right? A CapEx spend for the first two quarters this year were cut. And I'm very surprised that a lot of those major natty gas players finally decided to do the right thing for their investors and said, okay, let's stop all this spending because we got way too much of this stuff going out there. So yes, so inventory levels and production levels are starting to level out there a little bit, but you do have hurricane season. And then the amount of heating days or the lack of cooling days, which EIA calls them cooling days. I just call them heating days. That projection continues to increase on a week-by-week basis. I think we're at 17 now, additional heating days this year, meaning our summers are going to get hotter for an additional 17 days, which is what they're forecasting. And if you don't have to be a weatherman to trade natty, but you gotta kind of be aware that like there are reports that
we have a major heat wave coming into the Midwest too, right?
Yeah. And if we have this additional 17 days, 17 days, that's a month, right? That's a half a month, another 2 weeks. The revenue tailwinds for that on the utility side, man, it's a make or break for a lot of these utility companies. But I'm not going to go down the road of utilities, but yes, weather events, heating is going to be major factors when you're looking at the commodity space as a whole, especially from the energy perspective. Hey, Jason, do you have that chart real quick? I can kind of talk to that.
Yeah.
I wanted this capstone KRE. This is a horrible chart because I'm not, we're doing this on the fly here. All right, so the bar, the candlesticks are the TNX minus the IRX, right? So you're looking at the 10-year Treasury, which you can look at up in TNX CGI on TOS these days. Looking at that minus the 3-month. So this is one of the reasons why I'm a little concerned here, right? So we can see that there's definitely a trend or a correlation. It doesn't have to be a one-to-one correlation, but we see that there is one. So if that number, which is in negative right now, if that continues to go down, that means that the 3-month is obviously higher than what the 10-year is. And that's basically, that spread is widening out if it goes to the downside, right? That's not what you want to see. You don't want to see the yield curve continue to invert. We want to be on the other side of that, and we're not. And so if we're kind of seeing that reversal and kind of moving back to the downside, it's going to be pressure when you're looking at the regional banks. I just wanted to kind of highlight that. What is the reason why? Banks usually borrow on the short end of the curve. They lend on the long, right? And when I say the long, it's actually on the between 7 and 15-year curve. But if the price and the cost of short-term yields are still very expensive, the margins are going to be and continue to be very compressed. If you have compressing margins in an environment that is maybe seeing some cracking when it comes to the consumer, and you do see a little bit of slowing when it comes to housing, which is like a major bread and butter winner when it comes to lending for a lot of these regionals, they're not doing sophisticated derivatives trades. They're going out and you want a residential mortgage? Cool. Here's some money. Give us payments every month. It's very simple. If you have both of those combined at the same time, that's not good. That's devastating to a regional bank because you have lack of growth on top side, and then bottom line, you have compressed margins. And that's something that they just had to go through last year. And if that's going to be the same situation that we see if this yield curve continues to invert in the way that it's doing right now, in the trajectory that it's doing right now, yeah, regionals aren't going to catch a bit at all. I just wanted to break out why there's that correlation there and how it can have an impact when it comes to bottom line and top line growth.
No, I love it, and it's what we were talking about earlier when we're talking about the KRE, like, and the same could be said about oil as well. Oil and the KRE are very correlated most of the time, and that's because of the curve and what Kevin just explained. So, especially because banks deal with a lot of oil companies, especially the small regional banks. They're not just huge investment arms like the big banks. So, last thing, just to end on something, because I have the opposite view. So, me being the contrarian psycho person I am, I have to put this up and talk about it a little bit. So when we're looking at things and we're going failed breakouts, what Steven says is absolutely right. And everybody who follows my trading on Substack, you guys all know I love false breakdown signals. It's probably false breakouts, false breakdowns, probably my favorite signal of all time. However, what we're looking at here, and this is what I told you guys this earlier this week, but I'll say it again in case somebody didn't see it. Basically, if you take a ruler, you talk to an old school trader, somebody who's been a floor trader for many years. They used to take rulers or a pencil and basically draw a line where the most bars have hit. This is usually where you see the most support or resistance. Nowadays, we have things like open interest by price. If you have, trading technologies on, a StoneX account or something, or if you have, it's hard to get that, but volume by price is pretty common. So what you'd see if you have an open interest by price or volume by price on copper is that you'd see it probably end up around this zone. This is where the most bars have hit. We're dipping back into that zone. I'm not saying that I know for sure that copper will go up here and this is smooth skies, because what Steven said is absolutely really important, where it's when you have these breakouts and something comes down quickly, it's not something where you want to just be buying dips in. This could go a lot further. But I think if we got back and up and over a 10 EMA, something that gave some momentum behind it, you could buy this trend again if it stops around here. It just has to stop around here to make that possible. But also, just so everybody knows, full disclosure, I'm also speaking my book. That's the trade I'm in right now. The breakouts where that first red line is. This is the pullback to this zone at the moment. That's where my exit signal is, where the white line is. My trailing stop is that red line. So full disclosure, I am still long that trade. So, take my bias into consideration. I think that's always important to do, whatever you're getting your information from. But I do think that there's a possibility here of it moving up, or I'm going to get stopped out in like 5 seconds, and then we could just change the conversation.
I like this. I'll just add one thing to what you just said. You're absolutely right. The best way to enter new positions in a bull market is to actually buy weakness in the context of a primary uptrend, right? So I think we could check both of those boxes. You have weakness here, and I would say, yeah, this is a primary uptrend out to the 2022 lows and something like copper miners, right? However,
it's tough.
You're right. When you zoom out, we do have a chart structure here where the aphorism is that from failed moves come fast moves, and we want to be careful, right, cautious of that. So make this asset prove itself to you before getting in. If you're not in yet, you're already in, right? So if I'm not in the copper miners yet, I'm going to say, okay, this is a little dicey here. I don't love how we undercut those prior cycle highs and fell back into the range, but look at how far we've come off the 2022 lows, 200-day moving average, sloping higher. This is still a primary uptrend. You drop a VWAP. You could use the anchored VWAP for something like this to help determine who's in control of the short-term trend. If you drop an anchored VWAP from something like copper miners at the May highs, wait until price is back above that level. That's how we're confident and have conviction that buyers and bulls are back in control of the short-term trend, and then you want to ride that primary trend higher at that point. But I would make it like prove itself to me in a situation like this.
In my time frame too, on a weekly, I use weekly charts for all my signals. We're still above the VWAP at this point. So, and that's not to, once again, shorter term traders, longer term traders. I'm a much longer term trader than most people who are watching. So understand that if you were a shorter term trader, you would have been out of that trade a little bit ago. But longer term traders like me, we hang on to these major trends. Could we continue higher here? Absolutely. But I think it's good that we cover both angles of it. Like Kevin said, like there's something weird under the surface here. And I'm not able to see exactly what it is clearly. So once again, we need the market to confirm it. Once the market starts confirming it, I would be a little bit more interested in saying like, hey, the copper and oil could move up here. At the moment, they're struggling, but they're trying. We'll see where it ends up. And then make sure you guys tune in next Monday. Kevin and I will be on Monday. We're here every Monday at around 11 to 12 Eastern time, AM. So if you guys want to check out more stuff on commodities, Steve has a show 5 days a week with JC for All-Star Charts for Stock Market TV. So you guys check that out. That's at 8:30 a.m. to 10 every day. All types of guests. I go on there as well from time to time. So please come check that out with Steven. All right, guys. And make sure to follow Kevin at KG Bull and Bear. And go ahead, Steve.
Can I pump something real quick?
No.
Come on.
Of course.
I want to drop a link for everybody. We did a special event last night just talking about our process for going through insider filings and tracking insider trades, following Form 4s, Form 13s, the congressional filings, right? And how we use that information combined with trend reversals to try and, pick good entries in primary trend reversals as trends are shifting higher. So go check that out. Link to the video is there. It's one of the better things we do at All-Star Charts. So I think it's great.
I'm learning how to do banners. There we go. Cool. There you go.
Bang. Look at that.
So check it out. Definitely check out everything we're doing over there at Stock Market TV. Got a bunch of great stuff you guys could check out. And we'll talk to you all soon.
Have a good weekend. Later, guys.
See you.